In this video, we are going to explain how the safest bond market in the world turned into a battlefield, why Japan has been pushed into an impossible financial corner, and how a mechanism that has destroyed currencies and economies before is now activating inside the third largest economy on Earth. This is not a prediction, and it's not speculation. This is a pattern that only appears when debt math stops working, and once it starts, it never stops halfway. For decades, Japan's government bond market was considered untouchable. Stable yields, patient investors, zero volatility. Pension funds, insurers, and central banks treated Japanese bonds as an anchor of global stability. That illusion shattered on January 20th, 2026. In a single morning, Japan's 40-year government bond yield surged by 30 basis points, a move that normally unfolds over an entire month. This was not random market noise. This was a revolt. At the same time, Prime Minister Takaichi announced a 21.3 trillion yen stimulus package, the largest in Japanese history, and called a snap election for February 8th. Markets paused, recalculated, and then responded violently, because bond markets don't react to promises. They react to arithmetic. When a heavily indebted nation loses the confidence of bond investors, governments are always forced into the same dilemma. There are only two choices, and history shows there has never been a third. The first option is to defend the currency by raising interest rates and allowing bond yields to rise. This can stabilize the currency temporarily, but it causes debt servicing costs to explode and often collapses the banking system. The second option is to print money, buy your own bonds, and suppress yields by force. This stabilizes the bond market temporarily, but destroys the currency and unleashes inflation. Governments always believe they can manage the trade-off. They never do. We've seen this mechanism execute before. In September 1992, Britain attempted to defend the pound inside the European exchange rate mechanism. Hedge funds recognized that Britain's debt and economic fundamentals couldn't support the peg. The Bank of England raised rates from 10% to 12% in one morning, then to 15% by the afternoon. They burned through billions in foreign reserves trying to buy pounds in the market. 8 hours later, they surrendered. The pound collapsed 15% overnight, and Britain was forced out of the ERM. The market didn't break the system, it exposed it. In 1997, Thailand and Indonesia faced the same choice. Instead of raising rates and crushing their economies immediately, they printed money to defend their currencies. The result was catastrophic. The Thai baht collapsed nearly 50%. The Indonesian rupiah lost over 80% of its value. Inflation exploded, food prices surged, riots followed. IMF bailouts arrived, but only with brutal conditions: austerity, mass layoffs, and foreign control of domestic banks. Printing didn't prevent collapse. It only determined the form it took. Europe learned this lesson again in 2012. Greece raised taxes and cut spending to prove fiscal discipline. Bond yields still exploded. The European Central Bank secretly printed euros to buy Greek bonds and suppress yields. That failed too. Greece required 3 bailout packages totaling 289 billion euros and lost a quarter of its GDP. Only when Mario Draghi promised unlimited ECB intervention did contagion stop spreading to Italy, Spain, and Portugal. Even then, the damage was permanent. Now apply this mechanism to Japan. Japan's total government debt is roughly 1,200 trillion yen, about $9 trillion, equal to 250% of GDP. That is the highest ratio of any major developed economy in history. At the current average interest rate of about 1.2%, Japan pays roughly 14 trillion yen per year in interest. Painful, but manageable. But markets don't price today. They price trajectory. Japan's 40-year bonds are already trading above 4%. If that level spreads across the yield curve, annual interest costs surge to nearly 48 trillion yen. Japan's total tax revenue is only about 20 trillion yen. That means almost half of every yen collected goes directly to interest payments. Not healthcare, not pensions, not infrastructure. Just interest on old debt. But with nearly 30% of the population over 65, Japan cannot cut pensions without social unrest. They cannot raise taxes without killing growth. Defending the currency doesn't work. So the only remaining option is money printing. The Bank of Japan can create tens of trillions of yen and buy government bonds directly, suppressing yields by force. On paper, this solves the debt problem. In reality, currency markets react instantly. The yen is already weak by historical standards. Aggressive quantitative easing could push it toward 180 or even 200 per dollar. Japan imports most of its energy and food. A currency collapse translates directly into imported inflation. For a population that has experienced near zero inflation for 3 decades, this isn't just economic, it's psychological. Once inflation expectations break, the spiral feeds itself. People rush to spend currency before it loses more value. Velocity increases, prices rise faster, confidence collapses. And reversing that spiral would require interest rate hikes so extreme they would bankrupt the government outright. Japan isn't choosing between good and bad, it's choosing between slow destruction and fast collapse. There is no external rescue coming. The IMF doesn't have the resources to stabilize a $9 trillion bond market. The Federal Reserve will not print dollars to buy Japanese debt. China is dealing with its own crisis. Japan is too big to fail and too big to save, and bond markets have already forced the decision. What makes this crisis global is capital movement. Japanese life insurers hold over $1.1 trillion in U.S. Treasuries. For decades, the logic was simple. Japanese bonds yielded nothing, U.S. bonds paid 3 to 4%, hedge the currency risk, and pocket the spread. That trade just inverted. Japanese bonds now yield around 4%. U.S. Treasuries yield slightly more, but hedging costs erase the advantage. The math no longer works. As insurers repatriate capital, they sell Treasuries and buy Japanese bonds. When $1.1 trillion begins to move, global bond markets feel it. Treasury yields rise, European yields rise, emerging market currencies fall as carry trades unwind. This isn't politics, it's arithmetic. Japan has been the anchor of low global interest rates for 30 years. When the anchor breaks, every ship in the harbor drifts. Rising yields increase borrowing costs everywhere, from mortgages to corporate debt to government deficits. Central banks face impossible choices: intervene and reignite inflation, or stand aside and allow yields to rise until something breaks. This mechanism doesn't care about intentions, ideology, or promises. It executes when debt math stops working. Britain in 1992, Asia in 1997, Europe in 2012, Japan is now approaching stage 4. And unlike those episodes, this domino is large enough to destabilize the entire global system. Safe assets are only safe until they aren't. Government bonds are risk-free only as long as confidence holds. Once bond vigilantes revolt, the outcome is never negotiated. It is enforced. Japan is showing the world what happens when decades of low rates collide with reality. And the next moves won't be announced on television. They'll happen quietly in portfolios, long before headlines catch up. If you understand the mechanism while it's executing, not after it finishes, you have an advantage. History doesn't repeat, but debt math always rhymes. And right now the rhyme is getting louder.